Most investors think they understand silver. They don't, because what silver does in real market stress is very different from what people expect. And the mistake almost everyone makes with silver is the reason most people buy it at the wrong time. This video is about the truth most investors never learn until it costs them money. Most people buy silver for one simple reason. They believe it behaves like gold. They assume that when markets shake, currencies weaken, or systems come under stress, silver will automatically protect them the same way gold does. That assumption is the first mistake, because silver is not just money, and it's not just a safe haven. Silver lives in two worlds at the same time. On one side, silver is a monetary metal. It has been used as money for thousands of years. It holds value across generations. It exists outside the banking system. But on the other side, silver is also a critical industrial input. It is used in electronics, energy systems, medical technology, manufacturing, supply chains that depend on constant economic activity. This dual role changes everything. Gold only answers one question. Is trust in the system breaking? Silver answers two questions at once. Is trust breaking? And is the economy still functioning? That's why silver behaves in ways that confuse people. When fear rises but liquidity tightens, when credit stress appears, when markets are forced to raise cash, silver often falls with risk assets instead of against them, not because it failed, but because it's being treated differently by the system. This is where most investors get trapped. They see silver drop during stress and assume something is wrong. They think manipulation. They think weakness. They think silver isn't working. But in reality, silver is doing exactly what its structure forces it to do. During early stages of market stress, silver behaves like an industrial asset first, not a monetary one. Factories slow, demand assumptions change, speculators unwind leverage, paper positions get liquidated, and silver absorbs all of that pressure. Gold doesn't. Gold has one job, preserve purchasing power. Silver has two jobs, and they sometimes conflict. This is why treating silver like gold leads to bad timing. People often buy silver late when headlines are loud. They panic when it drops because they expected immediate protection. And they sell right before silver transitions into its monetary role. History shows this pattern again and again. Silver rarely leads during the beginning of systemic stress. It reacts. It compresses. It looks weak. Then something changes. Once liquidity pressure eases, once forced selling ends, once the system stops demanding cash at any cost, silver's behavior shifts. It stops trading like an industrial input and starts trading like money again. This transition is where long-term value emerges and where most investors are already gone. So the real truth about silver isn't that it's unsafe. It's that it's misunderstood. Silver punishes impatience, it rewards structure, and if you don't understand which phase you're in, silver will feel like a trap, even when it's doing exactly what it's designed to do. To understand silver, you have to stop watching the price alone, because silver doesn't trade in one market. It trades in two completely different systems at the same time, and those systems behave very differently under stress. The first system is the paper market. This is where most price movement comes from. Futures contracts, derivatives, leveraged positions, short-term speculation. In this market, silver isn't treated like money. It's treated like a trade, something to leverage, something to hedge, something to liquidate when margin calls hit. When markets shake, this paper system reacts instantly. Funds reduce risk, traders raise cash, positions are closed not because silver is weak, but because liquidity is needed now. Silver gets sold alongside stocks, bonds, and everything else that can be converted into cash quickly. This is why silver crashes often feel violent and sudden, not because fundamentals changed, but because leverage unwound. Now here's the critical mistake most people make. They assume this paper price reflects reality. It doesn't. Because while paper silver is being dumped, something very different is happening in the physical market. The physical market doesn't react in seconds. It reacts in behavior. When price drops sharply, physical buyers don't panic. They wait. Then they step in. Mints, industrial users, central buyers, long-term accumulators. They don't chase headlines. They watch availability. And this is where the disconnect begins. Paper prices can fall fast, and while physical demand quietly increases. But you won't see that in charts. You'll see it in delivery delays, premiums, dealer inventory, regional price differences. This is why silver crashes often feel wrong, because they are not demand collapses, they are position collapses. Once leverage is flushed out, the selling pressure stops. And when it stops, something important happens. Silver no longer needs buyers to push it up. It only needs sellers to stop. This is the moment silver transitions from a leveraged trade into a scarce asset. And this transition almost always happens after the crash, not before. History shows this clearly. Silver rarely explodes at the peak of confidence. It explodes after exhaustion, after forced selling, after disbelief, after people decide silver isn't working. That's why crashes are not the end of silver's story. They are the reset. The system clears weak hands. Paper claims thin out. Physical ownership concentrates. And then price behavior changes. Not overnight, not in headlines, but structurally. This is why timing silver based on emotion almost always fails. People buy strength. Silver rewards patience. People expect silver to act like gold immediately. Silver waits until pressure breaks. So when you see silver collapse fast, the wrong question is, why is silver failing? The right question is, which system is selling, paper or physical? Because silver's biggest moves don't begin when confidence is high. They begin when leverage is gone. Here's where silver becomes truly misunderstood. Because most people think price tells the truth. In silver, price often lies. What you see on your screen, the sudden drops, violent candles, sharp crashes, that is almost entirely paper silver reacting to stress. Paper silver is unlimited by design. It can be created, sold, shorted, and leveraged far beyond the amount of real metal that exists. One physical ounce can have dozens of paper claims sitting on top of it. And as long as confidence exists, that system functions. But when pressure builds, the illusion starts to crack. During sharp sell-offs, paper silver can fall dramatically, even while physical silver does not become easier to buy. This is the key signal most investors miss. Because when paper price falls and physical availability tightens at the same time, it means price is no longer reflecting supply and demand. It's reflecting control. This is why during major silver drops, you often see strange behavior. Dealers suddenly pause sales. Maintenance messages appear, delivery times extend, premiums stop falling or even rise. That shouldn't happen if silver were truly unwanted. But it does. Because the people who actually need silver, not traders but users, don't buy based on charts. Industrial buyers need silver regardless of sentiment. Electronics, energy systems, medical tech, they can't pause production because futures fell. Long-term holders don't panic, sell physical metal either. They don't check prices every minute. They care about ownership, not volatility. So while paper markets scream weakness, physical markets whisper strength. And that gap is dangerous, because the wider the gap becomes, the more unstable the system gets. Paper markets assume metal will be delivered if needed. Physical markets assume metal is scarce and worth holding. Those two assumptions cannot coexist forever. Eventually, one side forces the other to adjust. History shows how this resolves. Either paper prices rise to meet physical reality, or paper confidence breaks and the system resets violently. This is why silver crashes often precede powerful moves. Not because silver suddenly becomes valuable, but because the paper illusion becomes unsustainable. Another signal people ignore is global pricing. Silver does not trade at one universal price. Different regions pay different prices based on access, currency strength, and demand. When silver crashes in Western paper markets but holds value elsewhere, it tells you something important. It tells you price is being driven by financial stress, not metal rejection. This is not conspiracy thinking. It's structural. Paper markets are designed for liquidity. Physical markets are designed for ownership. And when liquidity is demanded urgently, paper silver pays the price. But ownership quietly consolidates. This is why people who only watch charts feel confused. They see price collapse and assume value is gone. But value doesn't disappear. It moves. From hands that panic to hands that wait. The silver market doesn't reward prediction. It rewards understanding structure. And the structure tells us this. Crashes don't mean silver is broken. They mean the system is revealing where stress truly sits. This is where most investors make their most expensive mistake. They assume silver and gold behave the same in a crisis. They don't. They never have. And when pressure hits the system, the difference becomes brutal. Gold is primarily a monetary asset. Silver is a hybrid, part money, part industrial commodity. That single difference changes everything. When fear enters markets, gold is bought for preservation. Silver is sold for liquidity, not because silver is weak, but because silver is usable. When funds, institutions, or governments need cash fast, they sell what is easiest to sell. Silver trades more like a commodity under stress. Gold trades more like insurance. That's why in almost every major crisis, silver falls first. Gold holds, or even rises. People see this and conclude silver failed. That's wrong. Silver is doing exactly what its structure forces it to do. In moments of forced liquidation, silver becomes a source of cash. Gold becomes a destination for safety. This happened during financial crashes, liquidity freezes, margin calls, systemic stress events. Silver drops don't signal long-term weakness. They signal short-term pressure. And here's the important part most people miss. Silver's volatility is not random. It's structural, because silver is smaller, thinner, and more leveraged than gold. It doesn't take much paper selling to move silver violently, and when leverage unwinds, silver exaggerates the move. That's why silver feels emotional. Sharp drops, fast rebounds, violent swings. Gold moves slower because it doesn't need to be sold to fund operations. Silver does. But here's where the misunderstanding becomes dangerous. After the liquidation phase ends, the roles reverse. Once forced selling exhausts itself, silver often rebounds faster than gold. Why? Because industrial demand never left. Because supply is tighter than paper markets admit. Because inventories don't magically refill. Silver doesn't get destroyed in crises. It gets reset. Weak hands exit. Strong hands accumulate quietly. And when the system stabilizes even slightly, silver reacts explosively. This is why history shows silver performing worst at the peak of fear, and best after the panic passes. Gold protects first, silver amplifies later. They are not competitors. They are sequential. Treating silver like gold leads people to sell at the worst possible moment. They expect stability, they get volatility, they panic. But volatility is not failure. It's the cost of exposure to a metal that sits inside the real economy. Another reason silver behaves differently is supply rigidity. Most silver is produced as a byproduct of mining other metals. Production can't ramp up quickly when price rises. And it doesn't shut down easily when price falls. That creates delayed reactions. Paper markets move instantly. Physical supply responds slowly. That mismatch creates violent price swings. Silver is not broken, it's constrained. And constrained assets don't behave politely under stress. They snap. This is why people who understand silver don't chase it emotionally. They respect its timing. They expect pain before reward. And they never confuse short-term price behavior with long-term value. This is the final piece most investors never learn. Silver is not meant to make you feel comfortable. It's meant to expose pressure inside the system. Gold preserves wealth. Silver reveals stress. That's its real function. Silver sits at the intersection of money, industry, and leverage. Because of that, it reacts first when something breaks. When confidence is high, silver is ignored. When systems tighten, silver screams. That's why silver crashes look dramatic. They are signals, not verdicts. Most people buy silver for the wrong reason. They buy it expecting smooth price action, constant protection, gold-like stability. Silver was never designed to provide that. Silver's role is asymmetric exposure. It absorbs pressure early. It releases energy later. That's why silver hurts people who enter emotionally and rewards people who enter structurally. Here's the pattern history shows again and again. First phase, liquidity stress, paper selling. Silver drops hard, headlines turn bearish. Second phase, forced selling ends. Physical demand quietly rises. Inventories tighten. Price stabilizes. Third phase, confidence returns. Paper and physical reconnect. Silver rebounds faster than expected. Most people enter at phase 1 and panic. Few people wait for phase 2. Almost no one understands phase 3. Silver is not a safe asset in the way people think. It's a transitional asset. It moves capital from weak hands to strong ones. That's uncomfortable by design. And this is where manipulation narratives confuse people. Yes, paper markets distort price. Yes, leverage exaggerates moves. But manipulation alone doesn't explain silver's behavior. Structure does. Silver reacts violently because its market is small, its leverage is high, its industrial role is real, its supply is inflexible. That combination creates stress sensitivity. Silver is not meant to replace gold. It's meant to complement it. Gold protects purchasing power during instability. Silver magnifies outcomes after instability resolves. When people treat silver like gold, they get disappointed. When they treat silver like a tool, they get clarity. This is why experienced investors don't obsess over silver's daily price. They watch physical availability, inventory drawdowns, industrial demand, policy pressure. Price follows those later. Not immediately. Silver is early. Too early for emotional investors, but perfectly timed for patient ones. The biggest mistake investors make is expecting silver to confirm their beliefs. Silver doesn't confirm narratives. It tests conviction. It punishes impatience. It rewards understanding. And that's the truth most investors never learn. Silver isn't broken when it falls. It's doing its job, exposing stress, forcing decisions, separating speculation from structure. If you understand that, silver stops being scary. It becomes useful. And once you see silver that way, you stop reacting to the noise and start positioning for what comes after it. That's where real advantage lives. Subscribe.